We now turn to a different type of investment with some mystery involved. The subject is collectibles, such as gold, silver, and art. Join Steve as he takes the mystery out of this category of investing.
There are many ways to invest your retained earnings. Remember, we earlier defined investing as the acquisition of an asset that first we anticipate will increase in value, and secondly, we anticipate that we can and will sell it in the future. With this definition in mind, there is an investment market in everything from gold to artwork to memorabilia and all things tangible. Let me start with gold and other similar commodities. Now I'll understand if someone says, why did you lump gold into this session? Isn't gold a more traditional investment? The answer is yes, but average people may own gold in the form of jewelry, and historically, much of the holding of gold and silver was done in things like tea sets and tableware. Thus, there is a collectible value as well as an intrinsic value. Gold and silver have long been measures of economic wealth. In fact, until the early 1970s, the U.S. currency's value was based on a fixed amount of gold. 1 ounce of gold at that time cost $35. Thus, post what's called the Bretton Woods Agreement that took place after World War II, the U.S. dollar became the world's reserve currency. It used to be said that the U.S. dollar was as good as gold, and that's why gold was directly fixed to the U.S. dollar. Now, gold and silver have unique metal properties that make them valuable, by the way. It's not just that they're shiny. NASA has been a huge user of gold in the space program because of its very unique conductivity properties. And silver is not only a superconductor and industrial product, but it also serves as an antibiotic. The reasons gold holds its value are numerous. First, throughout history, gold has been the safe haven when political and social chaos has reigned. Second, gold has been the safe haven asset to run to when banks have incurred chaotic times. Third, there are actually fundamental economic reasons that make gold unique. As I discussed, because of the conductive and reflective properties of gold, it's used in everything from making heat-reflective windows, to wiring for stereo systems, to protective coverings for satellites. It's a unique metal by every dimension. It's so non-corrosive that even if you set it in the ground for years and years and years, it would come out just as shiny as when it went in. Fourth, gold jewelry has been enjoyed and appreciated for thousands of years, and there's a steady and growing demand that meets or exceeds world production. Finally, going back to things we've spoken about, the world is hugely in debt, and I mean hugely. There's so much debt that there's not enough cash in the world to support it. So what's the answer? Well, it's simple. Print more money, right? Well, as that happens, the value of each individual unit of paper currency declines relative to goods. Well, as gold is basically the same relative value today as it always has been, at least as it relates to purchasing power, because it appreciates as your paper currency depreciates. And from what we know today, depreciation of the world's paper currency is a highly probable outcome. Now, please understand, it is my contention that buying gold, silver, platinum, or any other precious metal should be used to hedge your portfolio against inflation. The reality is, these metals increase in value due to the decrease in buying power of paper currencies. So unlike a company that generates a profit, gold gets its value from the excessive printing of paper currency. Yes, there are times when gold is undervalued or overvalued based on the emotions in the marketplace. Let's be realistic. In 2002, when gold was around $400 per ounce, could we not see the debt bubble that was building? Yes, we certainly could, but people weren't looking there. So you could argue that gold was undervalued at that time. Now, having risen 300% since then, yes, that means you tripled your money in gold. Is it today overvalued? Well, time will tell, of course, but I would suggest to you that regardless of its current valuation, you should have an allocation of gold or silver just to hedge against high inflation. And as we've discussed, the unsustainable levels of government debt might lead to high inflation. I've recommended generally that people hold 10% of their assets in gold. Why? Because that small allocation is enough to protect you if we encounter truly nightmarish inflation rates. I'm often asked what gold to buy and how to buy it. Well, let me cut through the clutter and provide some very specific recommendations. First, based on the research I've done and the professionals I've spoken with, I'd never buy the big 100-ounce gold bars. Now, these are primary exchange traded items between large institutions, and they trade on different quantities, but they have very high transaction costs. In addition, they're not that liquid, which violates the principal key we'd set earlier. If you walk down the street to your local gold dealer, they're not going to want to buy your 100-ounce gold bar because they, in turn, can't turn around and readily sell it. Number 2, don't buy gold coins based on their collectability. Look, we all love Elvis, and you can buy a gold coin with his image, but you're going to pay for it. You're going to pay a huge premium over the cost of the actual gold. This will rarely, if ever, pay you back. So unless you just collect things that are all Elvis, avoid buying the coins on their numismatic value. I have purchased silver bars in the past from places like the Franklin Mint, and I paid for the nice wooden box, the fancy images emblazoned on the bars and all that. But when push came to shove and they were sold, none of that mattered. The question was simply how much silver is in each bar. So the extra money then that I paid for the glitz simply didn't pay off. The solution is to buy gold or silver coins. In gold, I would recommend you buy coins minted by governments and not by private mints. For example, you can buy U.S. gold American Eagles, which are authorized by the U.S. government. You know what you're getting, and you can trust that transaction cost will be minimal. Many of these exist, from the South African Krugerrand to the Australian Roo to the Chinese Panda. But the most liquid coin in the world is the American Eagle. Now, you can buy coins like this at any local coin dealer, and there are many of these. Allow me to make a couple of further points. First, never ever store your coins at the local dealer. Take them home, put them in a bank safety deposit box, whatever, but do not store them with the dealer. Now, look, most people are honest, okay? But it only takes one dishonest operator to take your gold and run to the Bahamas. That's a real risk, so take possession of your coins at the time you pay for your coins, period. Secondly, have the good sense to check out the dealer you're looking to use. Check with the Better Business Bureau, and if you can, the best thing is to be referred by a friend who's used them before. Remember, purchasing investments in the world of precious metals is designed to hedge you against the inflation brought about by excessively printing money. So this is your emergency stock, if you will. The other point I want to make: during the Great Depression, President Roosevelt signed Executive Order 6102 on April 5, 1933. That executive order made it illegal to own gold, and it authorized the federal government of the United States to confiscate gold. Yes, that's right. If you owned gold bars, gold certificates, or gold coins for investment, they were confiscated by the government. It was then illegal to own gold in excess of a $100 value until 1974, when President Ford rescinded the order. With that knowledge, you should be aware that buying coins should be done as a collectible, which would have, in most interpretations, allowed you to keep your gold and not have it confiscated by the government. Do I think that'll happen again? Probably not. But remember, this is your emergency money, and if things get tough and the government does do that, the value of your collectible will significantly rise. Now, let me move on to more esoteric collectibles, and let me first make this disclaimer. Investing in these is something of an art form as opposed to a disciplined and measurable investment program. I mean, really, who of us sitting here in 2010 can, with any reliability, say that this painting or that painting will be worth more 20 years from now? Remember, it's not uncommon for priceless works of art to be worthless until long after the artist has passed away. Secondly, there are two really ridiculous situations that I want you to remember. In the 1600s, the Dutch came to be so crazy about tulips, yes, the flower, tulips, that tulip bulbs sold for as much as 10 times the annual wage of a craftsman. Let's put that in perspective. A UAW worker could easily be considered a skilled craftsman. Okay, let's say these folks earn $50,000 a year. That means that in the Dutch situation, the price of the tulip bulb was $500,000. Do you get the picture? People couldn't get enough of them, and soon enough, a huge bubble began to emerge in tulip prices. Well, think about this for a minute. Can you and I not just grow tulips whenever we want? These are not exactly difficult flowers to grow. Well, as common sense and economic reality would certainly emerge, the tulip bubble collapsed, and the last people that got in got cremated. The same thing happened in the 1990s. Anybody want to venture a guess? That's right, Beanie Babies. These machine-made little toys became so hot that prices began to rise, and some people actually generated income from buying and selling these collectibles. Okay, here are some of my basic rules for investing in collectibles. First, time will tell. You don't know what you have today that will become collectible tomorrow. Clearly, paintings by the great masters are collectible, as is a vintage 1968 Chrysler. But it's quite difficult today to know what will be valuable tomorrow. Second, tomorrow's value is oftentimes set by scarcity. There is only one Mona Lisa in the world. That's why it's so valuable. There are so many Elvis scarves in the world that they're not as valuable. I mean, you get the point. The rarer an item, the more value it will likely have over time. This isn't a perfect rule, of course. There are things we all own that are one of a kind. A picture from our children, a coffee cup they made. These are one-of-a-kind things, but likely have no collection value, at least in our time. Third, let's go back to the notion of time. Time, and at least here extreme time, tends to make things much more valuable. The coffee cup your daughter made may not be worth anything today, but give it 200 years, and it'll likely be worth something. 500 years, and it will almost certainly be worth something. But think about that for a minute. Unless you're investing for your great-great-great-great-great-grandchildren, time won't help. Finally, beauty is in the eye of the beholder. Therefore, if you buy an antique or a piece of art, you may enjoy the beauty of it while you own it, and thus you get aesthetic value in addition to possible economic value, and that aesthetic value might justify your ownership. So let's remember that we're in the realm of collectibles to protect our wealth from inflation, not necessarily make money over and above that. Now, there are certainly periods when collectibles outperform other assets, but unless you're consciously setting out to trade these items, that's not your primary concern. And don't forget, given the right collectible, you might get personal enjoyment from it, which hedges you emotionally against inflation too.
So, for those of you lucky enough to actually own these collectibles, remember that they are best used as a hedge against inflation, and also to remember to trade in those heavy gold and silver bars for government-issued coins. The next section is a complicated and advanced one, that of options and day trading. This is no hobby for the beginner and takes a great deal of experience, training, and knowledge. Listen as Steve explains.
This is a little more complicated than the other sessions we've done, so prepare to pay close attention. As your awareness and understanding of investing grows, you will become more and more interested in finding ways to make your money work as hard for you as you've worked for it. While buying stocks, bonds, commodities, collectibles, or anything else can grow your money, there are more active strategies that can make it grow faster, but the caveat is with more risk. An active strategy for our purposes here is one that has a fair amount of turnover compared to investing with a long-term horizon. These active strategies are not magic bullets, but they can be employed to enhance returns and generate what we will refer to in this session as extra alpha return. However, if these strategies are done correctly, then the risk you take may be worth the excess returns you generate. With that said, you must be willing to devote the time to truly learn these active strategies before you attempt to play against the professionals who do this for a living and have years of experience. Count on a learning curve of several months up to 6 months before you will want to attempt to swim in the fast currents of the day-to-day markets. In this session, we will cover 2 primary things. We're going to use our extra alpha return strategies to improve day trading and improve options trading. Day trading and options trading both are popular topics for the seminar series, and there are also many radio programs and other media outlets who tout these strategies and the returns they make as guaranteed ways to riches. While having devoted most of my adult life to investing, I can tell you directly and assuredly that there are no guaranteed ways to riches except hard work, and I mean really hard work, for a long period of time, and then a constant effort to maintain and expand your knowledge. Moreover, in life, if it's too good to be true, then it probably is, and you should frequently learn to walk before you run. Well, in the world of investing, it's no different. While there are no guarantees, the one who works the hardest and learns the most tends to outperform. In recent years, I've had occasion to go to a number of public seminars where the seminar operator sold the crowd on the notion of making unlimited returns by using some proprietary trading system. Really? Their system's that good? Okay, let me just ask you a common sense question. If their system is that good, why are they selling it to you? Their argument is that they've made their money and they want to help you and that they enjoy doing this. Nonsense. I say to you, they're in the business of selling you their system. If it worked that well, they'd simply do it. And you know why I can say that with such assurance? Capacity. We've spoken about this in earlier sessions, but any trading system has a finite amount of capital that can be traded under it. The reason is simply that the capitalization of the U.S. markets or any international market are simply not sizable enough to handle just any volume of trade on any instrument. Some instruments, like futures contracts, don't have the kind of trading volume to make things scalable. Therefore, I can state assuredly that these supposed trading systems can't be so great because if they were, they'd be arbitraged away almost immediately. That's how I know these seminar companies simply cannot deliver the results promised. One of them, and I'll not say which one, touts a system based on something called the MACD or MACD strategy. Now, in their seminars, they show you how powerful this strategy is. Okay, let's take a look at it. Well, MACD stands for Moving Average Convergence Divergence. It was developed by Gerald Appel in the late 1970s to track strength, direction, momentum, and duration of a trend in a stock or index price. This is a well-known technical indicator, and in retrospect, we can certainly find examples of where the MACD nailed a short-term trade, and that made the theoretical investor a whole bunch of money. Well, notice that I said in retrospect. Many institutional traders I've spoken with regarding MACD note that this technical indicator can provide many false signals at the turns, and often after a signal is given, it will reverse the other way. Now, this is a little off topic, but it's similar, so I'd ask you to bear with me. Have you ever heard about the Bible code? This is a theory that embedded in the Torah, the first 5 books of the Bible, God wrote a comprehensive forward history of the world, and all the events are recorded. So researchers of the Bible code have gone back, for example, and found references to the Black Plague, the Renaissance, the American Revolution, World Wars I and II, the Soviet Union, the Twin Towers attack on 9/11, and so on and so forth. Well, okay, here's the rub. Every time researchers find an event that was predicted, it's in retrospect. It's in the past. When it comes to predicting future events from the Bible code, well, that's just not that easy. It's the same with building investment systems. If we look in retrospect, we're easily able to find what drove a stock price up or down. But if we then use that same indicator to look forward, it may or may not be predictive at all. Now, I'm not saying all trading systems fail. The fact is they don't. And I know my share of professional traders who make a very good, almost obscene living from trading day to day. That's why I teamed up with a research firm that has catered to this universe of traders for many years. The name is Phil Erlinger Research. Phil ran the technical charting area of Fidelity for a number of years and then struck out on his own to support Wall Street's best and brightest. Phil has also been president of the Market Technicians Association, twice, by the way, and is a noted speaker on technical analysis. Phil notes that the secret behind the success of these professional traders is based on 2 big things. Number 1, they have worked very hard to determine a trading method that is effective going forward. And secondly, they've learned to have the self-discipline to follow the system and then figure out ways to improve on it as time goes on. Remember, we spoke about that when we discussed the attributes of a successful investor. We will detail in just a minute one such approach to day trading that Phil subscribes to and that day traders use. There are 2 basic types of investment systems in play today: trend following and contrarian. The trend following systems employed by traders work by identifying patterns based on the trends of a stock or option price. The underlying theme here is the trend is your friend, and that is a time-tested and proven concept. Some of these trend indicators are things like the 20-day moving average, meaning that you can track the recent history of a stock price, and when a stock price is trending above or below that signal, it's a buy or sell signal. On the other hand, the contrarian signal works by looking for reversals, in other words, a regression to the mean. For example, let's assume you're trading below the 20-day moving average. A reversal model might tell you to buy because it observes now that the stock is unsustainable under its historical average. The bottom line, sometimes you want to follow the trend, sometimes you don't. So how's that for the confusing two-handed economist? We discussed in earlier sessions the development of mathematical models that help you put discipline into your investment process. Day trading, like we're now discussing, is no different in that mathematical models are built to put discipline into the system. The models are built on factors like the 20-day moving average we just spoke about and can often integrate many of these. As systems become more advanced, they begin to migrate into the world of artificial intelligence, neural networks, and genetic algorithms, which are in and of themselves very good at identifying patterns. Individual investors like you and me can benefit from the development of the personal computer over the past 20 years that now possess similar computing power to the professionals. This applies to both technical and fundamental data crunching. What allows for successful day trading and options trading besides running the correct analytics? First, we must understand that all investing is simply trading in different time parameters. Day trading, just as the name sounds, implies trading during the course of a day. A buy produces a sell, and a sell or short produces a buy or cover. A slightly longer trading period could be called swing trading. This type of trading might last a week to several weeks. Now, even Warren Buffett buys and sells stocks, but his time horizon is much longer. The longer time horizon means the greater the ability to make greater percentages of money. The shorter the time horizon, the less will be made in absolute return. However, some would argue that more money can be made by making a little each day instead of a big hit over many years. We don't dispute this, especially when the markets remain in big ranges and trading ranges from low to high and back. It's a trader's market with the volatility that's going on intraday, daily, and weekly. What are the most important factors in trading, whether it's for a day, a swing trade, or long-term investing? The most important thing is to get the bias correct. Now, bias is a term that Phil Erlinger coined, and it's been used a lot in his research. The bias is the direction that the overall market is leaning. If you do get the bias incorrect, then no matter how good the setups and triggers that you have are, you'll be doomed to mediocre results. As an example, let's say for the day the market begins to sell off early and you try to buy the stocks thinking that a reversal will take place. The bias is clearly negative for the day and the chance of success will be low. Many traders fail to understand that fighting the bias is not a profitable approach, whether it's on the daily, the swing, weekly, or even the monthly basis. The bias indicator that Phil Erlinger uses something called the Displaced Moving Average Channel Indicator, or DMA for short. For whatever time period we're using, the DMA channel moving averages are taken from the high for 6 periods and the low for 6 periods. Now remember, I said over any time frame. The high and the low are then displaced by 4 periods. So if we're using a 5-minute chart, the moving average would be a 30-minute moving average from the high and the low. Remember, we said 6 periods, so 5 times 6 is 30 minutes. And then they're displaced by 20 minutes. In the workbook, we show you an example of trading action that took place on August 25th, 2010, using a 5-minute chart and the DMA channel. Let me walk you through this. As trading began that day at 8:30 Central Daylight Time on the 25th of August, the Standard & Poor's 500 index was below the DMA channel as the S&P 500 sold off at the open. We added to our strategy that we were using something called a DMA oscillator. This tool goes green when the price is above the DMA channel, yellow when prices move into the DMA channel, red when prices move below the DMA channel. At 9:30 Central Daylight Time, the bias moved to green until about 10:30. This resulted in a gain of little over 1 S&P point. Later in the day, a better bias trade was captured when 6 S&P 500 points were made from 12:10 Central Daylight Time to about 2:15 Central Daylight Time. If you were fighting the bias and shorting, then money would have been lost. The DMA channel can be applied across all time periods, and we'll talk about this more when you complete our certification of completion of this financial literacy program and join our very exclusive Buttonwood Club. Now, the above example illustrates a typical day of trading. A good day trader seeks to capture a couple moves in a day and then lock in the profits. However, a good trader will also cut losses when the bias moves to positive or negative and then reverses the other way. How do we do this? Well, Phil Erlinger believes that this is accomplished by using what are called setup indicators and triggers that will improve the timing of the trade once the bias is set. A setup indicator can either be a sentiment or technical measure. Keeping with our day trading example, a good setup indicator can be options activity. Now, an option is the right to buy or sell a stock, an ETF, or an index at a pre-specified price. Remember, we spoke about that in an earlier session. The right to buy is a call option. The right to sell is a put option. Sometimes during the day, a person will see that call activity picks up as investors believe that a positive catalyst will be forthcoming. Day traders pay attention to options actions as their day progresses. On August 25th, Electronic Arts traded 5,840 calls against a 10-day average sale of 1,447 calls. In the morning, the stock then languished, trading between 1470 and 1490. But then, around 11:45 Central Time, the stock began to lift from 1485, and then it closed the day at 1530. Remember, the setup for this action was heavy call volume. The bias began to become clear at this time as well as the stock lifted above its DMA channel. So we have both positive bias and positive setup in our view. Now, all we need to complete this is a trigger. The trigger can be a variety of technical indicators used kind of like the MACD we mentioned earlier or other indicators. The Erlinger Research Company has built a series of custom technical indicators that can be used as triggers. One of my favorites is the Erlinger Volume Swing Indicator, or EVS. Without going into detail, the EVS tracks when volume is turning positive or negative. A move above zero is a positive volume signal, and a move below zero is a negative volume signal. Well, on August 25th at 12 o'clock, the EVS turned positive. The price at that time of Electronic Arts was $14.88. The trigger, our EVS signal, remained a buy into the close, and the day trader went home with a profit of 48 cents that day. That may not sound like a lot, but when you look at it as a percentage of your capital committed and the frequency of the trade, it's a pretty good day's work. When day trading gets tricky is when the trade is taken as bias, the setup, and the trigger all move in sync, getting you in a trade, but then later in the day, either bias or the trigger reverse course. Here it becomes a matter of style as to when the trade is closed. For this trade, we elected to wait until the bias went negative or the trigger turned down. This happened at 2:15 Central Time and ended at 2:30 Central Time. However, our EVS indicator stayed positive, so we remained in the trade until the close. The S&P trade with bias indicators and Electronic Arts trade using bias, setup, and triggers illustrate how a day trader or day trading strategy works. It doesn't require work to sit through the day and make moves based on a disciplined system. The key to making day trading work is cutting your losses and letting intraday outsized moves on a relative basis play out. Another approach to an active strategy is using options. As we briefly mentioned above, options give you the right to buy or sell a stock without actually owning the shares. In our review of options, we're going to look at a review of who, what, where, when, and why in terms of the options, and then go into an example like we did with day trading. As we've discussed in earlier sessions, a call option gives the owner the right but not the obligation to buy 100 shares of stock for a fixed price through a given time period. In our beginning options courses online, we've often compared a call option to a pizza coupon. A pizza coupon? Well, a pizza coupon, as everybody knows, provides a right to buy a pizza. It's not an obligation. It also allows you to pay a fixed price for a specific deal, the number of pizzas, size, toppings, etc., and they go through some expiration date. This is essentially the idea behind a call option. The call option allows the holder to buy 100 shares of some underlying stock through the third Friday of the expiration month. Unlike pizza coupons, though, call options must be paid for, but the idea behind their mechanics is essentially the same. A put option, on the contrary, gives the owner the right, but not the obligation, to sell 100 shares of stock for a fixed price through a given time period. Hopefully, in the case of the put, the stock price will drop, and then the put will make a profit. For purposes of this discussion, we won't be reviewing that selling puts and selling calls are the more complex strategies like option spreads. We'll save that for you as members of the Buttonwood Club. Oh, the question is often asked, are options risky? I mean, why bother with something that can expire worthless? Shouldn't we just buy the stock? Well, we're going to take a look at why option strategies are becoming so popular and why someone might choose them as a primary tool for our excess alpha return strategy. While there are numerous advantages to options, most can be grouped into one of three categories. First, significantly less money is spent to gain control of a stock. Second, investors can alter the profit and loss profiles to accept or reject particular risks. And third, investors can profit from a lack of movement in the stock, which is certainly something that cannot be done with stock ownership. Let's take a closer look at each of these reasons in turn. Reason number one, putting less money down. If you buy a call option, you have the right but not the obligation to buy shares of the underlying stock. For example, if you buy a December Microsoft 25 call, you have the right to buy 100 shares of Microsoft for $25 per share at any time through the third Friday in December. Because you're buying a right to buy the shares, you only pay a small fraction of the cost of the stock. If the stock price rises, the value of the call rises as well, which means you can profit on the movement of the stock, just like the stockholder, but without spending anywhere near the same amount of money. For example, last week, Microsoft closed at $25.61, so you'd pay $2,561 for 100 shares. However, the January $25 call was asking only $1.80, so in effect, you'd pay $180 for the right to pay $25 per share for 100 shares through the third Friday in January. Now, because you're spending less money, remember, we only spent $180 to buy the options versus $2,500 to buy the stock. You have more money available to invest in other stocks or options, thus adding diversification to your portfolio. Options can also be a great tool for those investors just starting out, particularly in IRA or individual retirement accounts. Because of the limited contribution allowed by law, sometimes as low as $3,000, options can give you the chance to broadly diversify. For example, an investor with $2,000 in an IRA may not have a lot of choices if he wishes to invest in stocks. Because of the limited funds, he may forego his first choice of stocks and buy others where the outlook may not be as favorable. Options do not pay dividends, so that's something you don't get if you buy an option, and that's often a criticism made by stock investors. However, because option buyers spend less money to control the shares of stock, they will earn more interest on their remaining balances, usually paid monthly, rather than a relatively small dividend, which may only be paid quarterly. In many cases, these interest payments amount to more money than the dividend anyway, and they're an added bonus if the underlying stock doesn't pay a dividend. Investors who buy call options do not ever have to buy the shares in the underlying stock. Using the above example, as the price of Microsoft rises, the value of the call option rises as well, and the investor can simply sell the call option and profit from that increase. It should be noted that the call option will not rise dollar for dollar with the underlying stock until very close to the expiration date. And even then, that's assuming that the stock's price is greater than the fixed price at which the investor has the right to buy, in our case, $25. The main point that I'm making is that option investors can control the movements in a company's share price at a fraction of the cost, and there are numerous advantages in that alone. Our second reason is that you alter your profit and loss profiles. By purchasing options, investors create unique profit and loss profiles that can't be obtained through any other asset class. Options allow investors to bend and alter the profit and loss curves at various points. The ability to alter the straight line profit and loss nature of a long stock position is what creates a powerful dimension to options. Investors can alter their risk-reward profiles as well to suit their needs, and that can include speculation into risk management. So while an option will expire worthless if the stock's price doesn't rise above the fixed price or exercise price or strike price by whatever term, it's generally seen as a small price to pay for the numerous benefits that go along with it. Our third reason is to profit from a standstill stock. Option investors have yet another advantage over stockholders. They can profit significantly from the lack of movement in a stock. There are many strategies for doing this, but they all, in one form or another, involve the selling of time premium, and they fall into the category of premium collection strategies. Probably the most well-known of these is the covered call strategy, and we spoke about this in earlier sessions. With a covered call, the investor buys shares of stock and then writes or sells a call option against those shares. By selling a call, the investor has entered into an agreement to sell those shares if the long call holder decides to buy them. Because the investor has already purchased the shares, he knows he will be able to deliver them if the long call holder decides to buy them. It is the long call holder's right to decide if he wishes to purchase or not purchase the shares. In exchange for selling this right, the investor collects cleared cash that is available for immediate use for anything he wishes. Most covered call writers sell calls month after month, collecting relatively small premiums that can add up to big numbers at the end of a year. Volatile stocks that move sideways are ideal candidates for covered calls, since the great fluctuation in the stock's underlying price makes the option more valuable. If a stock moves sideways over a long enough time period, it can present a loss to the stockholder, if for no other reason than the risk-free interest rate could have been earned on the money had they not purchased the stock. Let's say, for example, a stock moves sideways over a long period of time. Well, the stockholder hasn't really made any money on the stock, and in fact, they may have actually lost money because rather than paying their money for the stock, they could have just invested it in cash and therefore earned an interest rate. Well, the covered call writer can profit significantly from this, often to the tune of 20% or more annually, because that stock, as it moves up and down within a trading range, is an ideal call option candidate. So let me summarize this session by saying three things. Number one, you can make extraordinary profits by successfully employing our active strategies. Number two, to be successful at that, you must first commit yourself to hard work and then commit yourself to continued learning. And finally, number three, you must have the aptitude, interest, discipline, and other characteristics that we've described to make this successful. And finally, you must find a model or a signal that genuinely works, not one that is just hyped up.
Make sure you know what you're doing before becoming a day trader, and don't be tempted by those who promise riches by simply buying their product that will teach you all you have to know. Ladies and gentlemen, students, homemakers, professionals, military personnel, and anyone who had the foresight to better their life by acquiring this program, you have completed a comprehensive 12-hour course on financial literacy that puts your knowledge on the path to becoming an independent, self-reliant, and prosperous person. You have our congratulations. Completing this course is a step toward transforming both your life and our society as a whole. As many of us know, financial literacy is a key component to our nation achieving its goals. Even the chairman of the Board of Governors of the Federal Reserve, Ben Bernanke, commented in a speech that said, and I'm quoting, "In light of the problems that have arisen in the subprime mortgage market, we are reminded of how critically important it is for individuals to become financially literate at an early age so that they are better prepared to make decisions and navigate an increasingly complex financial marketplace." In addition to simply providing financial literacy education, we've strived to make this program easy to listen to, easy to understand, and relevant to your life. We hope this eases the comments of Kansas Deputy Bank Commissioner Kevin Glendenning, who said recently that reaching adults remains a challenge. Again, I'm quoting, "Many of the problems and behaviors that can contribute to an individual's financial distress are the same issues that can make delivering financial literacy information to adults difficult." If you wish to proceed further on your financial path and perhaps begin learning how to truly trade your own retained earnings, we welcome you to join the Buttonwood Club, which is our private group of advanced financial users. We hope you've enjoyed this program and that you will be able to find ways to incorporate the information you've just learned systematically and effectively into your life. All of us at the Steve Beeman Group wish you happiness and prosperity in the 21st century. Please stay in touch.